Hey, what's up, guys? My name is Dory. Welcome to my channel, DK Invest. In today's episode, we're going to be going over growth investing strategies. In the last episode, just to recap, we went over the top four investing strategies. Those strategies were capital appreciation, capital preservation, income generation, and day trading. But today, specifically, we're going to be talking about capital appreciation or growth strategies. So let's jump right into it. So, part of having a growth strategy, the first thing to think of when it comes to a growth strategy is what your time horizon is. So, having a long term time horizon is very suitable for a growth strategy. You don't want to have a short time horizon and go into a growth strategy because you need time. Like sometimes your companies might fluctuate downwards and then you might lose some money. You need time for your companies to stay invested in the market so that you could withstand any short-term volatility or turbulence so they could grow in the long run. So number one to think of is a long time horizon. The second reason why you would want a long time horizon too, not just so that your companies could rebound, is because you need to have that mentality of the money that you invest in the market. You have absolutely no need for this money. So this isn't your emergency fund that you're going to be investing. Go say this isn't like your fund to your vacations or whatever slash fund that you have. This is not that. The funds that you put in your growth strategy should be funds that you absolutely don't need to touch for the long term, and that if you do happen to lose these funds, your life isn't sacrificed because of this. So that's the two things right there. Long-term time horizon and funds that you invest is you absolutely have no need to access these monies, and that if you happen to lose it, your life isn't compromised because of that. So a few ways to do a growth strategy. There's a conservative way to do it, there's a moderate way, and there's a aggressive way to do a growth strategy. So the conservative way would be to buy, I guess the first way would be to buy index funds. Index funds or ETFs. So what an index and ETF are is essentially like there's very popular indexes called the S&P 500, the S&P TSX, and the NASDAQ and the Dow Jones. A lot of popular things that people invest in is the S&P 500. What that is the broad American market. You're having access to thousands of American companies by just buying the index. There's a lot of ETFs and index funds that track the S&P 500. So that's not a bad bet because the S&P 500, if you look at the 10-year annual average return, it's about 10%, around 10%. So, you're beating historical inflation, you're beating GIC rates, savings rates. So you're beating a lot of the capital preservation options with buying the S&P 500. And for the amount of risk you're taking is very minimal because it's very diversified. You're not just buying one sector, one company. You're buying the whole U.S. Geographical location with the U.S. broad market. So you have good exposure there. This other index is the NASDAQ. If you want to get a little bit more aggressive, that is primarily your more small cap or tech sectors are in this NASDAQ. So there's a little bit more growth opportunity by investing in the NASDAQ index. Other things you could do that are more on the conservative side is you're limiting your small cap or medium cap companies, and you're buying specifically just large cap companies. And what large cap companies are is they just have a market capitalization of over 100 billion. So let's say or even over 50 billion, but just the market capitalization is significant. So when you look at some of the big companies like Apple, their market capitalization, I think they just hit 2 trillion. So that's a very big market capitalization, and they're considered large cap. And so that's another strategy. So going with large cap companies. So do some research, figure out what are the top large cap companies that you like, and you can invest in those companies. For a few examples, as I mentioned, Apple is one of them. Even though they pay a dividend, they're still considered a growth company, so that's not a bad bet. You could look at Walmart. Walmart's always looking to innovate. And there's other companies as well that you could look to do some research on. So that's those strategies. The more aggressive play would be not buying the index or not buying large cap just for the basis of buying a reputable company. But the other strategy is buying and selecting your own individual tech companies. So tech companies are ultra growth in nature because they're not paying dividends. They're looking to reinvest their profits into research and development, putting out new products out there, trying out new things like with AI and other developments. So some good example is the FANG sector. So Facebook, Apple, Amazon, Netflix, Google. You could buy index funds of the tech sector, which is be a little bit more aggressive than the index fund of the S&P 500 or the broad American sector. So you could buy a FANG sector index, so you buy all your big tech companies, or you could pick and choose which tech companies you want to buy. So when I first started investing, I kind of went all over the spectrum. I started buying all the big value companies: Walmart, Amazon, Facebook, Apple, Microsoft, Coca-Cola. I was buying all these big companies, but my returns weren't that good. So I started just diversifying, lowering my diversification and being more niche into the tech sector. So I bought all the tech companies, all the FANG companies. I bought Tesla. Then I started realizing some of these tech companies, they're a little stagnant. They're not growing too much. And when I was doing a future outlook, I noticed they don't have a lot of growth in the pipeline, or I thought that they might not do as well as certain companies in the pipeline. So as you get more experience, you start to fine tune your investment portfolio, and then you could start lowering your tech companies exposure, and you could start going into a few 1 to 3 companies that you truly believe have good financials, and that they have a lot of things in the pipeline. And that's essentially what I did. I kind of limited my portfolio to just 1 to 2 companies. Primarily, as I mentioned in the last video, 90% of my portfolio is invested in Tesla. I'm not here to give any investment advice on that. You shouldn't take my advice just to buy Tesla, but in my opinion, it's worked out for me very well. And the reason why I think Tesla was a good growth company for me was, number one, their financials were very sound. So they're efficient. Their gross margins were double than the industry standard. They're recording profits. They're growing by 50%. So that's number one, good financials. Number two, they have ultra growth pipeline. So they're not just in the car sector. They're looking to go in, they're doing a big AI play. Like their cars are self-driving. They're looking to get fully autonomous cars. So with that happening, your growth is essentially like it's 100% margins on that almost, because the software is selling itself. The software is already done. When the cars start driving themselves, it opens up the door to other sectors like robo-taxis and other AI plays, right? And they're also doing a robot called Optimus Bot, where they're going to be having this bot in their factories that they're going to help them assemble the cars. But not just that, they could start resourcing that to other sectors, so they could use those robots in their other factories as well. So there's a play right there. So first reason, good financials. Second reason, they have ultra growth pipelines. So there's a lot of things they're working on that would take them from the 700 billion market cap now to a 5 trillion, 10 trillion market cap in 10, 15 years. So that kind of ties to my first point of having a long time horizon, because you want these companies to fulfill your needs of ultra growth. So Tesla, they have things that need to take at least 10, 15 years with their ultra growth in their pipeline. So, and my time horizon with growth is long-term regardless. So the time horizons are incongruent with each other. So it's really good. So the third thing I like about Tesla, and by the way, guys, I'll do another video specifically on Tesla. Now is just a quick 3 tips why I think what you should do when you want to pick 1 or 2 companies. You should always have valid reasons why you pick those 1 or 2 companies if you're not diversifying. So the first reason with Tesla was good financials. Second reason was they have an ultra growth pipeline for growth. The third reason, what I thought, was they had vertical integration. They're doing a lot of things in-house, even though they're outsourcing stuff as they wish. Like if they want to get a battery, they could source it from another company, but they also make their own batteries. And not only do they make their own cells of their batteries, they actually get their own resources. So with batteries, with the electric cars, you got to get a lot of nickel from overseas. They're actually doing their own refinery plants. I believe one's in the States, where they're getting their own minerals. So it's just a good example of how their vertical integration. Another example is they did their own chips. So a couple of years ago, there was a chip shortage in the car sector. They started doing their own chips, and they're continuing to do that as they need. So they're not fully doing things on their own. They have that. They're number one, if they need to save costs, they'll implement their own. But number two, if there is a shortage ever again, they're not limited to other companies. They have their own stuff in-house. So those are the 3 reasons why I think Tesla met my criteria for why I should put most of my eggs in that basket. So I encourage you guys to find your own reasons to why you should buy just one company if you are going to take that strategy. It is a more aggressive strategy, so make sure that you have the right mentality and fundamentals going into that strategy. So that recaps it, guys. These were the strategies with being a growth investor, having a good time horizon, not needing the money you're investing, and then going over the companies that you want to invest in, whether it's the index funds, the ETFs, whether it's buying large cap companies, small cap companies, or buying just 1 or 2 ultra growth companies like Tesla. So there you have it, guys. These are your growth strategies. In my next video, it's going to be income generation strategies for you guys that have a lot of capital already built up. You're going into retirement. Now you want your money to start earning you some income. So I'll go over some strategies with that. If you like this video, guys, please like and subscribe and comment any suggestions if you have any, and I'll happy to take your suggestions. But otherwise, guys, God bless you guys, and stay tuned for the next video.